about short selling. I thought I'd talk about money market mutual funds, and I'd brave the slings and arrows of any or all of them, given what's in store for us. So turning to the first question of what went wrong, it's not time to summarize it. People's opinions are different and views are out. I thought obviously, easy credit terms, mortgage origination problems, over-reliance on the credit rating agencies are all part of it. But I thought I'd talk for just a minute about the large investment banks and what went wrong there. Because there's a lot of misapprehensions about that. People don't really understand at least certain parts of it. We supervise the largest investment banks on a consolidated basis. So you have to understand what that means. That's different than what we do for all broker-dealers. The SEC, my division in particular, supervises broker-dealers. There's 5,500 broker-dealers in the country. They're regulated entities. We supervise them. But there were 5 firms that were different. Morgan Stanley, Goldman Sachs, Bear Stearns, Lehman Brothers, and Merrill Lynch that we supervised on a consolidated basis. So as Frank is looking up at the ceiling there, you'll notice that most of them are not around in their current form. In fact, none of them are around in their current form. Each, however, represents its own story. We don't have time to go into its own story. It would be a mistake to think that the demise of each of them or their alteration in form was the same. They are distinct. What happened to Morgan Stanley and Goldman Sachs at the end of the run is very, very different than what happened to Bear Stearns at the front edge of the crisis. Bear Stearns, if you will, was a crisis of liquidity. And it was something that, in our supervision of them, we never, ever contemplated. We don't have time to go into the details of how an investment bank at scale as a holding company operates. But suffice it to say that liquidity for a holding company and for a large broker-dealer-oriented holding company like Bear Stearns is incredibly important. Unlike a commercial bank, which lends its balance sheet, an investment bank that's a trading firm is in the moving business. It's not in the storage business. So liquidity is everything, down to its policies for how it marks positions, for how it finances themselves. Those firms, those 5 that I named, were unsupervised at the holding company level. They had no regulation of any type at the holding company, full stop, up until 2004. In 2004, the European Union passed the Financial Conglomerates Directive. That said, if you wanted to do business in Europe as a financial holding company, you must have a holding company supervisor. Or you had to ring fence and create a sub-holding company that was separately capitalized within the EU. That's an incredibly inefficient use of capital. So these firms elected to have a holding company supervisor that was the SEC. They could have, by revealed preference, just bought a little tiny bank and had the Fed supervise them as a bank holding company. They obviously didn't want to do that in 2004. You can think about what they felt about later in 2008 when they made different choices. But they certainly didn't want to do it in 2004. So we supervised them not through statute, but by rule. The reason it couldn't be done by statute is Gramm-Leach-Bliley, which was the set of legislation that governed the division and ultimately the dissolution of the sort of the breakup between investment banks and commercial banking, left a hole. The hole was that if you were a financial holding company and you didn't have a bank, then you largely would not have, and I'm kind of glossing over a few things, you wouldn't have a holding company supervisor of any type. So that was a problem because Goldman Sachs had no holding company supervisor. You have to realize Goldman, as a firm, has 800 separately organized subsidiaries. They're mostly brokers. So Goldman has a couple of U.S. brokers. They've got a big UK broker. They have some other operations. But for the most part, 50+% of their assets sit in the U.S. broker-dealer. They are fundamentally a trading firm, I might say, a city group. But the interesting things in Goldman Sachs, the really sexy things, if you will, sat outside the regulated entities. They sat in unregulated derivative subs. You don't book a swap in a broker-dealer. That's a mistake. You don't book the swap because we're going to charge you capital. You book the swap in an unregulated entity. You don't have to run it through a broker-dealer because it's not a security. Once you book it outside the broker-dealer, book it outside a bank, nobody sees it. It's unregulated completely. Not only unregulated in terms of control, but nobody has books and records authority. No one can even see the thing at all. In 2004, we created a carrot and stick approach to those firms. We said, we will, as the SEC, go to Goldman Sachs, Morgan Stanley, and such, and say, if you let us have access to your holding company and let us supervise your financial and operational risk controls at the holding company level, then we will give you quantitative, the ability to manage your capital in the broker-dealer sub on a quantitative basis using things like value of risk. The trade-off, Holding company access for broker-dealer capital. That was the trade, and it was done by rule and not by statute. 5 firms took it. You had to have at least $5 billion of tentative net capital to do this. Only very, very big firms could do this because they wouldn't have the wherewithal to do it otherwise. Fast forward to 2008, the system tended to fall. The system fell apart for various reasons. In the Bear Stearns situation, if you go back and look, the reason it fell apart was liquidity. A securities firm like Bear Stearns funds itself in large part on repo. So for those of you who don't know how repo works, repo is just a process of financing a securities transaction. You can own $100 of security with $1 of capital. What you do is you say, go out and buy $100 of security, say, fine, take in the $100. Say, wait a minute, I'll pay you in a minute. Repo out the $100 over here. You take in 99, it's a secured loan. So $99 would come in, the $100 security goes out, it's held on a secured financing basis. Combine that 99 of cash with $1, pay it out there. What have you done? You own the security, it's held over here, and you own all the economic interest. You financed it on repo. These firms ran large match books repo operations. They repo out securities, they reverse them in. If you look at these firms, they were very, very large. They'd run 20, 30, 40% of their balance sheet at the holding company level on repo. That's what one of these firms did. When the credit crisis came, something happened that none of us ever thought would happen. We looked at repo as secured financing, and it was secured financing. You put the securities out, and they were financed. The basis of all secured financing is you don't have to care about the health of the firm that's doing the financing because you've got the collateral. That's the point of secured financing. So in our risk models, we said, if you get in trouble as a big firm, all your unsecured financing vaporizes instantly, and we made sure they had capital and liquidity to last for 1 year in that basis, 1 year. What we never contemplated was that secured financing, that is repo and other forms of secured financing, would vanish instantly, and it did. So understand what I say when I say it vanishes. I mean that a money market fund would not take a money good agency security that's full faith and credit, not full faith and credit, damn near full faith and credit of the U.S. government on repo and finance it. They wouldn't take a Fannie Mae overnight to finance it in the money market. And you can say, why would they do that? Because that wasn't contemplated by us. No one would take it. No one would finance these positions. And the reason was risk. They looked at these things and said, look, I'm a money market fund. I'll pick on money market funds for the moment, but the point is more general. They said, I'm a money market fund. If I think there's a real chance this guy's going down, Bear Stearns is going down, I'll finance somewhere else because I don't want to get involved in the legal hassle of deciding whether the collateral I have is good or perfected or whether I can sell it. So they refused to finance these firms on repo. So financing disappeared very, very rapidly. The week of March 10th, we thought a lot of money flowed out. Bear Stearns lost about $4 billion a day. We used to think that was a lot of money flowing out. They went from $18 billion and the liquidity flew down to about $2 billion in 4 days, and they were gone at $2 billion. That was not enough cash to run a firm like Bear Stearns, and that was the end of it. If you jump to September, when you get to things like Lehman Brothers and some of the others, it's a completely different story. Lehman had massively illiquid securities positions that were held outside the United States, non-U.S. subsidiaries that they hadn't sold over time. And in the end, the markets lost faith in their ability to finance those and lost faith in the valuations. But the thing that was salient about Lehman that we didn't understand that happened is that other players in the market behaved very, very badly. They grabbed collateral in a way that we didn't ever contemplate they would grab collateral. So you know what I mean? So these firms also, when they financed on repo, they would use tri-party repo arrangements. So these are third-party repo arrangements where there's an intermediary to administer the repo function. These were done out of Bank of New York before JP Morgan Chase. Those firms, when Lehman got in trouble, grabbed collateral in many, what I would say was an unconscionable way. They had enough collateral to protect themselves. When Lehman asked for their cash back, they fundamentally said, no, we're not giving it back. More to the point, if you want anything back, we want cross-collateralization agreements signed tonight. So they basically held them up on the basis of collateral. This is, you look at this and say, well, this shouldn't be happening. You have enough collateral to protect yourself. And their view was, there's never enough collateral. That drained liquidity from Lehman at a very, very rapid rate. Counterparts, swaps, and other over-the-counter agreements, if they were on the receiving side, they got the collateral. They got the marks that was posted, that were to be posted, but they didn't post to Lehman. And so Lehman lost liquidity through asymmetric marks of collateral. People wouldn't post to them. The swap went their way. And finally, entities like DTCC, which is the clearing entity for equity and fixed income trades, also played the same game with collateral. Lehman would have monies due to them. DTCC fundamentally wouldn't pony up the cash because they wanted to protect their own interests. They realized there was a time of legal uncertainty. The niceties could be settled out later, but they fundamentally held on to whatever it was they wanted to hold on to. That drained billions of dollars in cash on a real-time basis, and that didn't help Lehman in the end. And finally, you get to Morgan Stanley and Goldman Sachs. You have no idea how liquid those firms were at the very end. Goldman Sachs probably held $120 billion in purely liquid positions when they decided to convert to a commercial bank. And in their judgment, that wasn't enough liquidity to withstand the storm that they thought was coming, which is just a phenomenal thing. They were massively, massively liquid. And even they thought they couldn't withstand it. So that causes us to step back and think, look, it's a different world to manage these firms. We can't offer within the SEC's arrangement as a securities firm, when you're not a bank holding company, we can't offer an arrangement where we're a guarantor. It's just not the right supervisory regime. The perceived wisdom became at that moment that you couldn't do business as a securities firm unless you had a source of unconditional liquidity, unless you had a guarantor. And so even firms like Morgan Stanley and Goldman Sachs at the last moment flipped over into bank holding companies. So we'll see what that means going forward. You're seeing them trying to pay back some of those funds right now. We'll see what it means, but it's really, I think we all, at least at the SEC, we're really thinking about what that means in terms of innovation, because as you know, a great deal of innovation came from the investment banks, not from the commercial banks. We've really homogenized the landscape of our securities firms and our commercial banks to the point where I don't know if we'll quite be as robust as we once were. That leads actually into the next point, which is what we're doing now to sort of fix up the financial system, to think about that. So I mentioned credit rating agencies, I mentioned money market funds, I mentioned short selling, but I don't want to start there. I want to start with regulatory reform, because that's actually what's up today. The battles in Washington today are over regulatory reform. It's the question of who's going to supervise what and under what authority. It's a very fluid topic. It's fluid because the entities that are doing this are fighting a battle that they've been prepared to fight for probably 20 years. For us, we're just watching it from the sidelines, us meaning us in this room. But if you're a Washington person, you realize that a lot of these people have been waiting, if you will, a good chunk of their life to rejigger who's going to have oversight over what things. What do I mean? The Fed has for years hankered after money market funds, which if you looked at Paul Volcker's comment, said these are just bank products outside the banking system, right? They've had that sticking in their craw for a long time. You've got to believe that the Fed and Treasury have been sort of after or eyeing the large investment banks forever, because that's a big chunk of the business that they're not running. And so there's a chance for these things, if you will, they're up. They're up for grabs, and I think if you look at the reorganization of the financial landscape, you're seeing that they're in play. There's two ways it's coming out now. It's coming out in its first form as a question of who's going to resolve a troubled institution. In its second form is who's going to be a systemic regulator. But they're after the same point. They're after the point of who is going to supervise large firms, especially at the holding company level, whose supervision was indeterminate. So let's think about them each in one point. The resolution authority. The problem is that there is no resolution authority for holding companies. And when I say holding companies, we've got to be clear what I mean. Banks, if they get in trouble, get resolved through a process that was set forth in fiducia. The FDIC is a big part of it. If a bank can be resolved in a particularly streamlined way, it's a least cost resolution mechanism. If it can't, there's a structured formula whereby there's a process. It's got to be approved by a set group of the Fed governors. The president has to concur, at least not object. And then a commercial bank can be resolved in a more costly way that protects against systemic risk. On the broker-dealer side, broker-dealers get resolved. They don't go into bankruptcy. They go into liquidation that's overseen by SIPA, which the entity that oversees it is SIPC. So it's the guys with the little emblem that's when you go to your broker-dealer. It says SIPC, $500,000 protection for your account. These are the people who resolve the broker-dealer. The framework for regulation of a broker-dealer is that we don't care as the SEC if a broker-dealer melts. We just don't worry about that. What we care about in our whole regulatory regime is built around the idea that if a broker-dealer goes out of business, customers' cash and securities are returned to them promptly. That is the regulatory regime. That's how we protect customers in those settings. But in each case, neither the bank holding company nor the holding company for the broker-dealer has any resolution regime whatsoever. There just isn't one. Nor was there one, of course, for AIG. But importantly, Bear Stearns, the holding company, AIG, the holding company, and had it happened, Citigroup, the holding company, had no resolution regime. That's a very, very difficult problem because not only is it a domestic problem, it's a global problem because these firms are globally incorporated. So that's the first thing that's up, if you will. And if you've watched carefully with Barney Frank's committee, who's been very aggressive about saying they want to provide this authority to the Fed or whoever it's going to be, most likely the Fed, that this is one avenue to get at this authority. Of course, if you have resolution authority, you have presumably supervision authority on the way there to control the risk. The second thing that's up, and the second way this is being cut, is as a systemic risk regulator. You've all seen this discussion about systemic risk. Again, I keep mentioning the Fed, but the Fed probably gets named most often as a systemic risk regulator. There is a second regime that's being pushed by Chris Dodd, who's head of the Banking and Finance Committee, that says maybe we should form a slight consortium of regulators who get together, a few from the SEC, a few from the Fed, a few from Treasury, a few from the CFTC, who, if you will, form a kind of oversight committee looking at systemic risk, much the same way the National Security Council collects intelligence agencies together to oversee certain things. I think the thing you got to appreciate when it comes to systemic risk is the key issue, at least from my point of view, is you've got an entity like the Fed or Treasury that's guaranteeing financial intermediaries, and they seem to me they have every right to manage the size of their guarantees. You've got to put out there. They want to manage the size of that put, their liability, but they have to do so within the framework of the fact that they guaranteed entities that are under the functional supervision of other folks. So in our case, they've guaranteed money market funds, but we comprehensively supervise money market funds. They guaranteed broker-dealers. Again, we comprehensively supervise broker-dealers. They've guaranteed insurance entities that are comprehensively, allegedly supervised by the states, et cetera, et cetera, et cetera. So you've got a problem. You've got puts that are being managed that are at least being issued by an entity that doesn't supervise. We can't live within a world where those puts aren't issued. I think that's what people are thinking at the moment. It's an arguable proposition. Probably not time to talk about it today. But the world is thinking that you have to have someone guaranteeing, so how are you going to have them managed? You got to, at least from I think my perspective, that's the whole game. Is that the Fed gets oversight by virtue of the put and their issuance of the put, and they get to manage the size of that liability. They are fundamentally supervising these entities. Because I will tell you, when it gets down to the short strokes at the end, when the firm is in trouble, nobody cares about anyone who doesn't have money. That's very, very clear. When it came to Lehman, when it came to Bear, when it came to all these things, no one would answer our phone calls figuratively, so to speak. You didn't need to, because we weren't going to bail you out. It was only the Fed and the Treasury who were going to bail you out. So to me, the debate today about who's going to be the systemic risk regulator is the debate about who is going to manage risk in the financial system. Because as it's being passed, the authority that's going to be given to that systemic risk regulator will fundamentally trump any kind of basic regulation. So, and what am I talking about? Things like clearing. The Fed doesn't supervise, nor any systemic risk regulator supervises clearing for securities firm. Under Section 17A, the SEC is plenary authority over clearing. But clearing is a systemically important function. I would expect the Fed to try and get a hold of clearing. The same way I expect them to try and get a hold of risk at broker-dealers and have them oversee risk at insurance intermediaries as well as money market funds. So this, all I'm saying is this situation is playing out now under the guise of systemic risk, but I really think it's the main show, because once this gets allocated, what's left is going to be relatively small when it comes to the regulatory landscape. All right, that's it for regulatory reform. Let me talk about three other things concretely, because they touch upon securities and things that we do. Let me start with credit rating agencies, since that's at least a topic for tomorrow. I don't want to jump on what people are talking about tomorrow, so I'll talk about it only from our perspective. You should know that anyone can be a credit rating agency. You could be a credit rating agency tomorrow. All you have to do is hang out a shingle and say, I rate credits, and you're done. Now, credit rating agencies became special, if you will, by the SEC's authority way back in the 70s when, in my division, they came up with the idea of nationally recognized statistical rating organization. We said, and it really came from just these few letters. It's amazing what you can do if you're not careful when you write letters. We said that we will not recommend that the commission we will recommend the commission not take an enforcement action if A broker-dealer calculates its net capital using the ratings of this particular rating organization for its calculation of its net capital. That's all we did. So it was for calculation of broker-dealer net capital. From that letter, which was granted ultimately to 13 credit rating agencies for purposes of broker-dealer net capital, everything mushroomed. This designation of NRSRO came, everyone came to rely on it, and a tremendous amount of moral hazard was created. There was really nothing more than those letters, so that is the genesis of it. Fast forward to 2006, Congress had been beating on the SEC for almost a decade to come up with an objective, reliable, transparent process for who could and who could not be an NRSRO. We refused to do it, so Congress in September of 2006 produced the Credit Rating Agency Reform Act, which did a couple things. First, we're the only jurisdiction in the world that regulates credit rating agencies. The authority tells the SEC that they must regulate them, they must register credit rating agencies, and what's interesting is what it says we can and can't do. It says we must promote transparency, we must come up with schemes to minimize conflicts of interest, either by prohibiting certain things outright or making sure there are policies and procedures to manage conflicts of interest. And most interestingly, it says we are absolutely forbidden from interfering in the process and mechanism by which credit ratings are struck. We must completely stay out of that business. We have no right to do it. So if a credit rating agency wants to throw darts at a dartboard, this is figurative, to come up with their credit rating, we would, in theory, have nothing to say about that. We would measure the size of the dartboard and disclose it. We would measure the distance to the dartboard, but we could not critique the method. And that's meant to be, that's at the heart of the legislation, because the legislation is aimed at a market solution. At its heart, the legislation says, look, make it transparent, make it work well, and then the market will reward the best credit rating agency, where best is defined, presumably, as the folks who are most accurate. Of course, that doesn't work. It doesn't work because there are a couple odd attributes for credit rating agencies, one of which is that if you are the best credit rating agency, you don't necessarily increase your market share. There are examples of that. Without naming names, we have had credit rating agencies come into us and say, look, in this particular class of mortgage-backed securities, we figured out our models were wrong, we tightened up our models, the models now that we produced led to lower credit ratings for this class of mortgage-backed securities, and here's our market share for our ratings in that. And guess what? Their market share fell like a rock. So you all know what that's from. That's because you have an issuer pay model for credit rating agencies. So that's a problem. Someone who allegedly is more accurate loses market share. That arises in part from the issuer pay model. We at the SEC, because we regulate this, are faced with what is really a very, very difficult problem. I think that we don't have a terrific answer for this. We held a roundtable the other day. We are charged with, and our chairman has gone out on a limb in many ways and said, look, we will attack this problem. We'll try to come up with a solution for it. But when we stop as a group and ask ourselves, what authority would we want to help us regulate credit rating agencies more effectively that we don't have? We don't have a terrific answer to that, actually. I don't think congressional authority is the answer. The reason is there's a market failure of sorts there. The failure, from my point of view, rests with investors, not so much with credit rating agencies. The curious thing to remember in this space is that the issues that were rated, the mortgage-backed securities and the CDOs, were constantly institutional contracts. They were institutional securities that were bought by QIBs, they were bought by institutional investors. People who understood the nature of the conflicts with credit rating agencies and the nature of what those, really how serious those conflicts were. If you talk to large institutional investors, you look at their credit rating group, it's not uncommon for them to have an ex-credit rating agency person on their group. So they knew the game. The curious thing is, why did they not pay more attention to it? If you get these folks in a room and talk to them quietly and privately, you know, they'll have different answers, but at least some of them will say, look, you got to understand, we've got thousands of credits under management. We can't analyze them all. We've got 15 credit managers. How are we going to look at 8,000 credits? So sometimes we just buy the rating. And I fundamentally believe these guys in part just bought the rating for part of their solution. So you've got a couple things working. You've got a true conflict of interest problem on the credit rating agency side, but the users of credit ratings, the institutional users, relied on them excessively. The problem is no one's got authority over those institutional users. They're pension funds, their mutual funds, their endowments, their hedge funds. Sure, some of them we regulate like pension funds, but they have a fiduciary duty to investigate and to suss out the quality of their investments. I think a reasonable analysis of part of this could be they fell short on that side. You have to stay tuned for what anyone does in this space. I don't know if the Fed is going to label credit rating agencies systemically important or not. It's not beyond the pale, of course. If you look at TARP, if you look at that TALF, if you look at some of these facilities, you will see that not only do they rely on credit rating agencies for what securities are eligible for these facilities, but they will parse the credit rating agencies more finely. They will say you can only use AAA securities issued by the major credit rating agencies, meaning the top 3. Now, since we've registered credit rating agencies, we've gone from the 4 or 5, many of you know, to 10. I'd be curious if anyone in this room can name more than 4. Anyone think they can name more than 4 credit rating agencies that are NRSROs? Anyone who has a paper on it cannot raise their hand. I can't, and I think I signed them all. So, I mean, look, there are 10 of them, a few from Japan, a few from, a few very, very small ones. Some of them are, in fact, subscriber pay. But the lion's share of the business is concentrated on a very small number of them. So that's credit rating agencies. It's going to be a tough problem, but it's going to be an important one given Reliance. I don't see Reliance as anytime soon. All right, let me transition to the next thing, which is, short selling. So something about which everyone in this room probably has an opinion. So there'll be a paper tomorrow, at least one, on short selling issues. The SEC had a trajectory in the area of short selling that's long-standing. We promulgated, well, first, go back to 1938, you had 1081, that was the old uptake. Served us pretty well for a while up until July 2007 when we got rid of the uptake rule and said, look, after great deal of analysis and study and academic papers and roundtables, yada, 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 it did no good, maybe it did so harm, and there's no good reason to keep it. And I think that's what it all reduced to, and so we eliminated it. It didn't even make the Wall Street Journal on the day we eliminated it. I looked at the paper the next day. It wasn't even in the paper. It was not news at all. Today, at least over the last 3 months, according to our chairman, it's the thing she is most called about and most pressed on is the uptick rule. The amount of pressure we get on the uptick rule is phenomenal. The president calls about short selling. It is, that is not an exaggeration, the previous one, not the current one. It is absolutely the case. You cannot believe how much pressure we get about doing stuff about short selling. The best guys are the guys who run the investment banks and the commercial banks, where at the same time, the CEOs are calling saying you've got to do something about the short selling, and the guys in the desks are calling saying don't do anything about short selling. It's absolutely hysterical, but in all seriousness, since we are a political agency, it brings tremendous political pressure to bear on us. You shouldn't doubt that we're a political agency. If you look at the way we're constructed, no more than 3 of our commissioners can be from the president's political party. We are beholden to Congress. They fund us. We respond to our congressional oversight committees. The SEC is cast as a political agency. This has become a political issue, and we respond to it as such in part. That said, as you know, we brought back, we proposed to bring back the uptake rule or some form of the uptake rule the other day. That's only a portion of what we do with respect to short selling. The other thrust with respect to short selling has to do with failures to deliver. So you know when you sell short, you fundamentally borrow security, you got them, you deliver them according to your obligation. Well, there's a process known as naked short selling where you may not deliver the securities, you may not even borrow them. Whether or not that's problematic depends on your view of how markets work. I suspect there are people in here who think failure to deliver on short selling obligations is not really a problem. There are other people, some of them not in this room probably, who think that it's a tremendous problem. We've come out somewhere in the middle. That's the SEC. We've said, look, we are tightening down on delivery requirements for borrows of shares. If you borrow shares, you've got to deliver them by a fixed period of time. We set it at 3 days, at T+3. We will give you to the morning of T+4 to cure that. If not, we fundamentally say that the clearing broker who has a fail into the continuous net settlement system can no longer short shares without first borrowing them. We create a penalty for clearing brokers who fail into the CNS. And that actually has cleared up failures to deliver in a remarkable way. There are now two stocks on the NYSE and 3 stocks on NASDAQ who are on the threshold list who have serious amounts of fails to deliver. The rest are ETFs and other kinds of structured products. So there's only 5 names. So we've cleaned that up to a significant extent. That said, we remain under pressure. The Commission's going to have to decide what it does. There is a force that says within Washington that is saying, and look, it's people pressing on Congress, it's people pressing on us, who say things as simple as bring back the uptick rule. It worked for 75 years. How could it go wrong? Just bring it back. Notwithstanding the way we trade today, we're in a post-NMS world, all those things you know better than I, why it doesn't make sense in some ways. On the other hand, our congressional oversight committees have said things to us as simple as, you know, sometime you're in the business of taking things off the table, and this is one of those times. So politically, you're in a very, very interesting place. Do you want to imperil the health of a regulatory agency and its longevity at a time like this, when in a world where there's a regulatory jump ball and reg reform is up for grabs, you refuse to come forward and propose something like the uptick rule or an upbid rule or some kind of a circuit breaker? On a principal reason, maybe you say, no, we shouldn't do it because you say my analysis says there's no reason for it. On the other hand, if you take a slightly longer view, you take a slightly more nuanced view, you say, maybe I will propose this, maybe I'll even adopt something because I want to keep the SEC intact as an agency. You shouldn't mistake that people's intent within Washington would dismantle at least parts of these regulatory agencies. Let's face it, we're back on our heels. Madoff didn't do us a whole lot of good in terms of our DC. And at a time like this, if you're at the head of a regulatory agency, you've got to factor those things in. That's short selling. Credit rating agencies have said, last thing, then I'll stop, is money market funds. Money market funds are in some sense the most difficult one because the money market rule, the condensed 2A7, the rule that governs money market funds down to its essence, it says, it's a definitional rule. It says, if you want to hold your share price at $1, you must do a bunch of things. Fundamentally, keep your credit quality high and keep your tenor short. Then you can have a $1 per share money market fund. That's really what the rule does. Obviously, that didn't work, especially with Lehman shares that Prime Reserve broke the buck, and then some other funds around Prime Reserve also failed when Prime Reserve failed, when the Reserve Fund failed. It's also the case if you watch the paper that some undisclosed other number of money market funds and their sponsors, the sponsors providing credit support to money market funds. It's not clear how many those are at this moment. So you've got a world where money market funds are imperiled. The Treasury's created a structure where they're guaranteed. So we're stuck in an interesting position. What do you want to do about money market funds? It's questionable whether they can operate without a guarantee today. The fear of the run of money market funds was such that even the Treasury felt that they had to step in. So there's a balance. On the one hand, you've got the traditional bank view that says these are banking products, they should be eliminated, they should be guaranteed, they should be brought within the banking system. On the other side, you have a capital markets view that says, look, that shouldn't be done. We maybe have to revisit the 2A1 framework, the 2A7 framework, and how they're managed. We really want to keep them outside of that bank framework because they've conveyed a lot of value to investors. They provide liquidity, they provide yields over above bank yields, and they've done a lot of good because on the issuer side, they've allowed issuers to use commercial paper instead of bank loans to fund their operations. So we get caught in this middle ground. But again, the guarantee is issued by some portion of the government. They have the right, I think, and we should expect them to have the right to use that guarantee. And in the course of that, I think there's going to be a tendency for them to want to draw money market funds into that web. How might they do that? They might demand oversight over the holdings of those funds. But you can see what the tension is. A bank regulator is not going to like the idea of growing their healthy money market industry because it's disintermediating the banking function. You've got banking functions performed outside the banking world. It's not hard to think that you might want to novel these guys, the money market funds, enough to cause bank products to start to compete more favorably with money market products again by either charging high premiums, by restricting the asset side, the asset quality, by bringing the tenor down. So we're caught again in this middle ground of what's going to happen. It was highlighted today, and this is the last thing I'll say. If you saw the Wall Street Journal, what this tension is, you saw that Ken Lewis was testifying at the New York AG. And what he was testifying about was what the Treasury and what the Fed told him around his acquisition of Merrill Lynch. They were telling him, Mr. Lewis, don't disclose the difficulties you're having with Merrill Lynch or Merrill Lynch's financial position because that might cause a run on that portion of the financial system. Don't disclose that in your proxy filings. Don't disclose that in your normal disclosure you would have around a vote or a shareholder vote around the acquisition of Merrill Lynch. And if you, at least according to what the testimony reported as, were you to disclose that, we might replace you as CEO and your board as the board of this firm. So that's one branch of the federal government watching safety and soundness in its typical bank prudential way. On the other hand, you would have the SEC, or they too have been there, saying, wait a minute, shareholders have the right to know information about shares they own. They may be Merrill Lynch shareholders, they may be Bank of America shareholders, but a CEO has an obligation to disclose material information in front of a corporate transaction. In that world, you would expect them to disclose, but clearly you had a conflict. You had a conflict between a prudential or a systemic risk regulator and a market regulator like the SEC who would have wanted that disclosed. In this particular setting, what happened was the information wasn't disclosed. But I just use that as a point to illustrate the conflict that's going to arise. That conflict is there in so many ways. It's there with credit rating agencies, it's there with disclosure, it's there with money market funds, and it'll be there with the oversight of complex financial intermediaries. And what Congress is going to have to grapple with right now, what they're trying to grapple with, is how to unwind that. So that's all I intend to say. So happy to take any questions, but that's just so I'll take questions. Yeah. Jim?
So Eric, here's a tough one, but it's not as tough as it sounds because it's not your decision. But why did the SEC miss the Madoff issue?
We can't talk about short selling. Why did the SEC miss the Madoff? So there's a lot of reasons for that. So can we talk hypothetically about why a regulatory organization might miss something that was tipped about repeatedly by someone who had something credible to say? I think, look, it's hard to say. The first thing is that we took in we've taken a lot of tips, right? So we didn't have, and we're trying to improve our process for processing tips. That said, you look at that, we're not an empirical organization. The SEC is dominated by lawyers. It's a lawyer-driven culture. It goes back to 1933, 1934 when the SEC was created. It was born out of the Harvard Law faculty. And they were sort of like, let's get the best lawyers running it. It was crafted that way. You know, their first chief economist was fired within 2 years? It's true. So economists didn't fare well with that organization from the get-go. It's not an empirical organization that doesn't use data as well as it might. It's also in its branches that deal with enforcement and oversight like exams. It's not populated by people who understand financial markets the way I think they want to. So you wouldn't find people who were ex-traders, ex-portfolio managers, or even people who had master's degrees from sort of finance-oriented programs that would help them with that. So they didn't process the information, I think, as well as they might. They're not risk-oriented. Some of the most critical people, those functions, those exam functions, this enforcement function, would say it has a kind of check-the-box mentality. So I think changing that is very, very important. The SEC has been characterized as being a law enforcement organization and not being as close to the markets as it would be. It has tremendous drawbacks to take that view. So, for example, if you watch the way the Fed works versus the way the SEC works, the Fed is very good at having relationships with its regulatees where it has conversations with them. It learns from them, there's give and take, but they're very, very prescriptive, much more prescriptive and intrusive than we are. It's very surprising. People don't get that. They are more prescriptive and intrusive than we are. But there is a give and take. So what's unusual for the Fed is that having had that give and take, they drop the hammer on you and take an enforcement action against you. The SEC, on the other hand, is often characterized as not having much of a give and take. On the other hand, when they find out you did the wrong thing, they'll hammer you. So that doesn't lend to much institutional learning, at least in the way you would like to have it. And so those are at least people's characterizations. I think all those build into why we're not as tuned in to those kind of things. That said, I think our current chairman is aimed at fixing that. Look, it's a huge black eye for us. People are very upset that they missed that. $50 billion, at least is the nominal number that's being kicked around. Look at the effects it's had. It's crushed our agency in terms of credibility. More to the point, it's done tremendous damage to people. And that's only just now coming up. If you're watching, there are now clawbacks. The statute provides, the CIPA provides, that you can claw back money. So people within 6 years, which is the statute in New York State, within 6 years took their X $1 million out of Madoff, they're going to get their money clawed back to pay off the estate. I can't imagine what that's going to be like. People are going to lose, after all they've lost, people are going to lose homes, they're going to lose businesses, they're going to lose all sorts of stuff in the name of that. So the tragedy just continues. Yeah.
So, I'd like to ask I think answering a hypothetical, I think is a good way to proceed. So let me ask another hypothetical motivated by the Ken Lewis Bank of America example, which I found fascinating in today's journal, and I found it fascinating at an earlier stage, maybe 2 months ago, when kind of an earlier form of this started to emerge. So hypothetically, if some senior federal regulators tell a major firm that's subject to disclosure regulations by the SEC not to make disclosures which any competent securities attorney would view as material, is that the basis for an enforcement action and an enforcement investigation? And in the course of that investigation, should senior government officials be called in to testify? You know, we're now talking about issues involving the CIA's. In other contexts, the government is talking about doing investigations of where senior government officials provided guidelines through lawyers about what the CIA can and can't do. Well, you read this article about Bank of America, and it sounds a little bit the same. And arguably, again, it's those senior government officials, they weren't even the ones responsible for enforcing the disclosure laws.
Obviously, they weren't.
What?
They weren't. That's right. They didn't have a disclosure.
Yeah. So hypothetically, is this sort of within the scope of the SEC? Well, can the SEC call in senior government officials because in effect, if an enforcement action were pursued against a company like Bank of America in this situation, part of presumably Bank of America's defense would be to point to these other guys with important positions. That would be part of their defense. I'm kind of curious as to how one should sort of think about this issue, because it seems to me this issue seems to me to be a huge challenge to the SEC's disclosure framework.
There's no way I could answer that question.
Okay.
So look, I think I would just point to this by saying this is a conflict that arises within other contexts. We've already talked about one, which is one where there are solutions that are for prudential regulation. We have an opaque little firm is in trouble, it's handled opaquely. Camel's ratings for banks are opaque. Firms that are in trouble that are being worked on by prudential regulators do so in the dark, right? There's not information provided. The same is true with certain accounting issues, right? So you've seen the give and take over fair value accounting, over reserve accounting. The SEC, in the name of providing information to shareholders, says we don't want you creating what we would call EJR reserves. We want you just to be very direct with what your earnings are, let them vary over time. Banking regulation on the prudential side say, no, go ahead and allow earnings smoothing. We'll let you do that. We think it provides for a more safe and sound banking system. So there are, I would say, it's just another instance of with resolve that regulators, that's what Congress is trying to decide. I suspect a systemic risk regulator will always be in trouble and squeeze what they do. But I don't know how that's going to, I mean, given your point for what happened to data paper, I don't know how that works out. I mean, the senior management of that firm has got a lot of explaining to do. And the private bar is going to have a lot to say about that, for sure. There you go.
The bus should be out in front.
They're very small in front of the bar. You know, unlike interest rate swaps, which are 10 times larger.
But are they
No.